All right, let's kickstart the first conversation of the day. And this conversation will be split into three distinct topics. We'll begin with a conversation about the SEBI rule that came in, or the circular that came in for mutual funds that related to bundled products that offered investment and insurance. We'll understand what this is and why this move is significant and may not be the best move or result for customers. Kirtan Shah is joining in. Kirtan Shah, of course, of Credence Capital. Thank you so much, Kirtan, for taking the time, and good evening to you. Could you tell us a little bit about this product before we get into why the regulator possibly said that this would not be allowed?
Alex, thank you so much for having me on the show. So, Alex, this was an additional feature in the mutual fund SIP that was offered by some AMCs in some particular schemes of theirs, where if you opt for that particular scheme and this added feature, then you would get 100 times or 120 times of the SIP that you do as insurance cover. So let's say if you are doing a 10,000 rupee SIP, a minimum for 3 years, then you would get, let's say 100 times, which is 10 lakhs of term insurance free along with the SIP. Of course, the caveat is that the term insurance is only applicable and available as long as you continue with the SIP. But if you continue with the SIP, this 10 lakh of SIP came free along with your SIP investment option. And that is the long short of this additional feature that mutual fund used to offer, Alex.
Okay, but who was taking on this risk? It wasn't the mutual fund, right? It was essentially a third party that was taking on the risk of that term insurance.
Oh, absolutely. Unlike how a ULIP typically operates, where the insurance company manages the risk as well as the investment, I think mutual fund had a very interesting and very clear demarcation that mutual funds will only focus on managing the investment, and the risk, which was the insurance, was outsourced to an insurance company. The mutual fund guys never took on the risk management part of it.
Okay. Now, to that end, this was never being viewed, Kirtan, as something that would replace term insurance or the requirement for life insurance. It was something that was an added feature, right? So in any case, I think customers should not have gone into it with that mindset, correct?
Oh, absolutely not. I think, look, there are multiple challenges with respect to this bundling, right? So the first challenge was that there was a maximum cap of how much insurance are you really allowed to take, one. Second, you had to continue your SIPs to make sure that this insurance cover continued, right? And also that this insurance cover was only applicable till the age of 55 broadly, right? So nowhere this was, in my opinion, communicated at large, or probably the impression was made saying that this product will take care of the term insurance requirement that you have. This was definitely a supplementary product to the term insurance that you would otherwise have had to have. So definitely this was an additional feature and not to be viewed as a product that would take care of your risk management as well, Alex.
Okay. So, but Kirtan, it's a benefit, significant benefit if you think about it, right? And you gave us the multiple, and 10 lakh is nothing to sneeze at if you're talking about additional cover that you have. So why would the regulator have an issue with this?
Look, largely, I think, Alex, the regulator thinks that this probably is going the way the ULIP products on the insurance side operates, right? The regulator wants to make sure that the mutual fund company focuses on the investing side of mutual fund. And because insurance as a product is not under the purview of SEBI and it is an IRDA regulated product, I think they wanted to have a very clear demarcation between an investment product and a bundled product which offered investment and insurance like a ULIP does. But unfortunately, Alex, I surprisingly don't see IRDA taking similar steps which SEBI does, right? So if you look at a ULIP product, A ULIP product is a very similar product where you have an insurance and an investment that is bundled together. But unfortunately, what happens in a ULIP product is the insurance part as well as the investment part, both is managed by the insurance guys, right? Unlike, like I explained to you, how the mutual fund product operated, where investment was managed by mutual fund and the risk was outsourced. ULIP took both of that together and tried managing. So I really think IRDA should be the first one to bite the bullet and say that, I want to keep a clear demarcation between how investments and insurance as a product will work together. But I think SEBI has been proactive this time around, in my opinion, to go ahead and stop such a product.
It's interesting, and I'm glad that you brought that up, because traditional wisdom, or at least a lot of the financial planners that I've spoken to, very strenuously argue against the adding up or the bundling up of insurance and investment. They say that each has a place in your financial plan and in your overall financial lives, and each should be looked at in a very specialized manner. Do you conform to that view as well?
Oh, Alex, absolutely. I think you should not mix insurance and investment at all. But I have a very contra view than most of my other industry colleagues on this particular part when it comes to the mutual fund plus insurance bundle that just got banned. And I'll give you a couple of reasons why I think very differently than most people that you would otherwise talk to on this particular topic. Look, first, while we talk about ULIPs, right? As and when, how does a ULIP operate? You invest 100 rupees in a ULIP. Some part of that 100 rupees is taken out to get you a cover, right? And the remaining amount gets invested. Now, the older you are, the more is taken out of your investment to give you an insurance, and less gets invested towards towards investment. I think that is the biggest problem in clubbing investments and insurance together, which is offered by the insurance product. What happens on the mutual fund side of the product that just got banned, that 100 rupees that you invested, that entire 100 rupees was getting invested in the mutual fund. The additional insurance cover that you bought was completely free, right? Now you would ask, how can it be completely free, right? Was the expense ratio of the product high? So just to tell you, the expense ratio of the product was also nowhere exorbitant than outside of the SEBI rules or otherwise, right? Then who was paying for it? The TER, the total expense ratio that the mutual fund company got, mutual fund companies were paying out of their own pocket to offer this additional free insurance to people who subscribed, right? Now, of course, the discussion can be around, why the mutual fund company is wanting to do that. I think that's a sales strategy or a customer acquisition model. But there was no difference in the NAV offer scheme where you offered or opted for the insurance cover and you didn't opt for the insurance cover. So the same scheme offered you the same NAV, whether you opt for the insurance or you don't opt for the insurance, right? So I don't see a reason why, if this is not hurting the investor, right? And then there is an additional component of free insurance that comes along, right? Why should anybody realistically have a problem where it's the AMC which is biting the bullet on paying for the expense? Of course, the question here, I've read so many of these articles saying that what if the performance of the scheme is not good? Your corpus over a period of time will not be able to take care of your retirement and stuff like that. Look, there are multiple schemes available across AMCs where you could switch. Today also, while you do mutual fund investing, and if a scheme is not performing well, you typically end up switching it, right? You could have done the same thing. Of course, yeah, the options available were lower than you would otherwise have, but it was not that there were no options available. And like we've already spoken, I think this was not the solution to your term insurance, but this was an additional opportunity for you to have had covered. Imagine situations of people who otherwise don't get term insurance for various other reasons. In this particular product, there was no medical test required for you to really go ahead and get that insurance. So to that vulnerable class, which never got term insurance, this was a brilliant product which got discontinued.
Okay, fair point. And you've raised some fair points. I guess one could, try to glean what the regulator has tried to do, and said that this may be some reason for investors to choose to continue with a scheme despite it not fitting the criteria. But that's, I guess, another argument. I take your points entirely. I want to move on to another subject, Kirtan, and I wanted to speak to you about this. I've been wanting to speak to you about this, the Employee Provident Fund, and there is buzz that they're going to increase the equity allocation in the EPF from the current 15% over a period to 20% first and then to 25%. So first I want you thinking as to what happens when this equity is increased. From 2015 to now, we've seen that it's gone from 0 to 15%, and that's perhaps why they've managed to give 8% plus returns in a situation where all other fixed income instruments are not giving you that. So what is your initial thinking of this? And we'll get to the rest later.
I think, Alex, like you rightly said, if you look at the fixed income world today, right, on a post-tax basis, there is no product, in my opinion, that comes close to what EPF is paying, right? So if you are talking about EPF paying you 8.1, in spite of you look at how it has come down from what it was originally, look, rates are going to come down and there is no option in a developing country. You look at economics globally and you will understand that, as and when the economy moves from developing to developed, rates are supposed to come down. So if at the EPF level, we want to still maintain rates or interest rates which are better than most other products available, I think the equity component will have to be increased, because you will not be able to generate premium interest rates or returns that can be offered to the subscriber over any other similar product available in the market unless the equity side of the component does not function well. And all of us know in the longer run, equity will definitely do well. So I think this movement from 0 to 5% to 10 to 15 and now the buzz around 25 is in the right direction, in my opinion, because this will make sure that the EPF interest rates are always at an advantage to most other fixed income instruments that you would generally see around in the same category, Alex.
Okay. In the context of other very large pension funds around the world, and I remember having looked at the Canada Pension Fund, and it has, I think if I'm not mistaken, 2/3 of its assets in equity, which is both public and private. So in that context, the EPF is still miles away from that. The question really is that if there is a sizable allocation towards equity, Kirtan, could there be lumpiness in the returns that are given on an annual basis by the EPF?
So, Alex, like we are aware, there is a predefined interest rate component that is spoken about, right, or announced of what a particular financial year will be paid out to. So, to that extent, it is the EPFO / the government taking the risk of announcing a particular rate that they are willing to pay for a particular financial year, right? So, as and when the more that really keeps getting added to this entire portfolio, right? It is invariably the EPFO and the government, in my opinion, that are ending up taking slightly higher risk at their end. Of course, with all due respect, everybody is doing the right kind of calculation for them to come out and announce what kind of returns they are willing to offer for a particular time frame. But definitely, having said that, the lumpiness will definitely increase. But I think if you look at it from a longer time frame of whether how this will really help, in my opinion, this will really help support falling interest rate to the investing component of EPF. So while you will see that 100% debt products in the market over the next 5 years, 10 years will fall down on their rate offerings far significantly faster than probably an EPF because of the equity component.
Fair enough. Now, I did want to draw a comparison. I know there is not a like-to-like comparison, Kirtan, between NPS and EPF, though it is offered to a few employees that don't have access to EPF as a retirement product. And there are various options within the NPS, which is perhaps why it's not directly comparable. But for somebody who is looking at these two options, either VPF, which is voluntary provident fund, which allows you to maximum go to your full basic, and of course the tax-free nature would be to 2.5 lakh rupees worth of contributions every year to the EPF through the VPF, or NPS, which according to you is the better route to go?
So, Alex, one more data point before I kind of answer that question. Look, largely while we talk about EPF, the data is very straightforward, where 85% of subscribers of EPF are typically the lower income salaried people where their basic DA is 15,000 and below. So for those guys where this investment is made on a compulsory basis, where they don't really want to do something like that, I think a fixed rate is brilliant, right? So the 85% of the people, I don't think are really looking at an option outside of EPF. Talking about the remaining 15% where the basic plus DA is much higher and they can do a VPF kind of an option. I think they have to look at it in two different contexts, right? The first is while you're talking about probably contributing more, right? While you would want to contribute more, I'm assuming that you have higher income and probably higher disposable cash flows that can go towards investing. Now, if you have higher disposable income and cash flows that can go towards investing, why do you really want to get stuck with an 8.1 and probably falling over a period of time, right? You might as well use that money to do an SIP through a mutual fund. Now, where do you want to do that, in an index or an active or a passive, is a separate story. But if you have higher disposable income, right, why do you want to stick to a fixed income paying you 8.1? You might as well go ahead and do SIPs, right? But there is this another school of thought where we are saying that, if you can do additional 50,000 of rupees, you probably might get higher tax deductions in an NPS. But my problem with NPS is it has some other challenges also, right? So like you have liquidity challenge. You can't remove your money as and when your will. While the corpus gets accumulated at maturity, you can only remove 60%. The remaining 40% has to compulsorily buy an annuity. Today, you and I both know what lower rates are offered in annuity today, right? So largely, I would say if there is somebody who really wants to build a corpus towards retirement and is looking at doing additional investments, right? If your choice, given your risk profile, is fixed income, then definitely doing a VPF makes a lot of sense. But if your risk profile allows you to take slightly more risk, I would rather suggest you do mutual fund SIPs than doing an NPS or a VPS.
That's very nicely put. I think because the tax-free nature of that 8.1% is what draws people to the VPF within that 2.5 lakh bucket, of course. The last point that I wanted to discuss today has to be that floating rate deposit that was introduced just this week by Yes Bank. Do you think that this is the start of what I think a lot of banks will offer? And how do you rate this product, especially for people that are very comfortable with fixed deposits, possibly those that are senior citizens that are dependent on fixed income and fixed deposits in particular?
Alex, again, I have a very contra view than what you will hear financial planners tell you about this. I think this is a brilliant innovation in the industry, in my opinion, right? The only challenge in this product, as per me, is for you to get the interest rate cycle correct. And very importantly, what tenure do you want to invest in? So to give you an example, these products are today available anywhere from a 6 months, 12 months range to start with up to 3 years. Now, if you end up locking yourself in a 3-year product, you might realize that the interest rate cycle actually changed over the next 18 months. And you are locked in a product where the repo is going down and your interest rates are falling, right? So while this is a brilliant product, I think you have to keep two things in mind. First is try and make sure that you get your tenure absolutely correct, because if you don't get your tenure correct, you might be on the wrong side of the curve. But if you can get your tenure correct in investing in this product, I think this is a very, very interesting product. I'll tell you why do I make that statement. Now, generally, you will see a lot of us comparing fixed deposit with mutual funds on the debt side. Now, because this floating rate product is less than 3 years, the tax advantage that mutual fund got would get dismissed here, right? So you are talking about apple to apple between the fixed deposit and the mutual fund product, right? When you're talking about taxation, right? The only challenge, in my opinion, that the fixed deposit would typically have is liquidity. So if you locked yourself in for 18 months, you might not be able to remove your money at fair price. They will deduct something if you remove early. So that's one advantage that mutual fund has. But for somebody who's looking at fixed returns, I think this is a brilliant product. And I'll tell you why do I say that. You look at a liquid fund or a money market fund or a low duration ultra short term fund on the mutual fund side today, which is 1 year, up to 1 year kind of investing, the YTMs are close to 5.5-6%. You look at this product, up to 18 months, you are getting a fixed 6%, right? So you are getting a fixed 6% versus mutual funds, there can be some volatility. I would rather opt for this because there is no tax advantage. Now, if you look at up to 3 years, right? So if you look at a short-term bond fund or a corporate bond fund today, is generally offering a 6.5 to 6.7 YTM minus expenses will be less than 6.5. You look at this product up to 3 years, it is offering 6.5. So while you talk about returns post-tax, I don't see a reason why you should opt for a mutual fund while this product is available. Two things that you have to keep in mind, like I said, don't get your interest rate cycle wrong. So if I were to invest in this product right now, I will not invest more than 18 months because I think interest rate cycle will change post 18 months. So do an 18-month kind of investment, provided you will not want liquidity in any sense. Because if you're talking about liquidity, then mutual fund becomes a better product. So if you don't want liquidity and you want to invest up to 18 months, I think this is a good product.
And you also have to factor the senior citizen rate, which I think, if I'm not mistaken, is 50 basis points higher, Kirtan. But thank you so much for summing that up. I think that makes a lot of sense, and we've discussed a lot of topics today. Thank you so much for taking the time.
Thank you so much for having me.